the ultimate multitasking.
Welcome, everybody. We see you rolling in to our Scalar and Cooley and Thelander panel today on private company valuations and compensation. I'm going to go ahead and get started with our intros while everybody gets situated to be respectful of time. I'm J.Thelander, founder and CEO of J.Thelander Consulting, and I'm glad to have here Matt from Scalar and Ali from Cooley. Matt, I'm going to turn it over to you. We've had a nice relationship with Scalar. You're a piece of the pie that fits in nicely with compensation and private companies. So share with us what Scalar does and your role.
Yeah, absolutely. Thank you, Jody. Pleasure being here. So I'm the managing partner here at Scalar. Scalar is a business valuation firm. So all we do is business valuations for all kinds of reasons, but really the most popular of those reasons being around equity issuances to employees. So a lot of 401(a) valuations or profits interest valuations. We're headquartered in Salt Lake City, but most of our clients are all over the country and really all over the world. We largely work with venture and private equity backed companies, so institutionally backed companies. So the heat map of our clients probably, mirrors a venture heat map. A lot of both coasts, Bay Area, Los Angeles, Texas, New York, Boston, everywhere in between. And we've had the pleasure of doing this for 15 years, working with thousands of companies at this point, do a few hundred valuations a month. So
Wow.
a lot of volume and a lot of exposure to really cool companies, really cool industries from pre-revenue startups to pre-IPO companies and even public companies.
That's great. Well, we're glad to have you here today. And Ali, one of my favorite people to work with.
Oh boy, we probably ought to just leave it there. I am Ali Murata, a partner in the compensation and benefits practice at Cooley. And my practice is really a life cycle practice. I work with emerging growth private companies through large cap public companies, advising on compensation and benefits matters along the way, particularly equity compensation and equity incentives. Lots to unpack there, particularly depending upon the stage at which the company finds itself. Have had the pleasure of working probably with thousands of clients, I'm guessing at this point as well, along with Matt, and have been, if I didn't mention this, this is now my 25th year, heading into the 25th year, and I don't even know how that happened since I am so young, but here we are.
Exactly. I don't know how that
Um,
happened either.
yeah, and really looking forward to all of this. Love partnering with Jody on these conversations because I really think that it is helpful for folks to see how all of the pieces fit together.
Yeah, well, that's a perfect segue in. So, listen, we handle the compensation, the combination of cash and equity, and the different job titles. I'm going to move into our slides. We have a lot of ground to cover in terms of information, but we also really want this to be interactive. Morgan on my team and all of us are actually going to follow the chat in addition to the fact that you sent some questions ahead of time. So please, if something comes up and you want us to slow down or go more in depth, we are counting on you to keep this interesting today so that we can, it can be interactive. So I'm going to go ahead and share my screen. And now I'm going to make this full screen. There we go. Perfect. So I'm assuming that everybody can see the slides. And we're going to talk a little bit about sort of the background of Thelander and who we are and what we do. We've had an exciting couple of weeks here. We were just in Forbes magazine for an article on our investment firm compensation, but our data has been featured all over the place in the last year in terms of both private company compensation as well as investment firm compensation. And the we cover multiple industries, which is, hang on one second. I'm seeing a note coming in here. Okay, it says I'm not sharing. Hang on 1 minute. Let's see what's going on here. Oh, there we go. Hang on. Okay, I think we're sharing now. All
Yes.
right. Thank you for that note. I see my phone lighting up. I know that that's something seriously going on here. All right, let me move this around though. This here, and I'm going to move us into full screen mode. Okay, perfect. I think that's a little better. Okay, so getting into it, hide this. All right. Does this look right, everybody, or no? Finally, I heard finally now. Okay, good. Mission accomplished. Sorry about that. All right, back to J.Thelander, our data. It's like I run out a start here today. I apologize for the technical difficulties. Okay, industry is really important, and it used to be even more important, but we're seeing now that whether you're a tech company, which could be a lot of different things, or you're a biotech company, or you're a medical device company, compensation is starting to look really similar across all these sectors because there are jobs that are moving and you can be hired as an engineer likely in any of these industries and sectors, and there are a lot of positions now that are just not unique to one, so the compensation is starting to look very consistent across cash and equity. And in addition to that, because it's taking so long for both tech companies as well as life science companies to have any liquidity, the cash and the equity is getting very stable, especially if you're a key person. Very relevant to today, and we have questions talking about one of the questions was about asking if an investor, how they look at, here are my notes, looking at compensation, from a board member or from a VC perspective. And we think total financing raised to date is the right way to be looking at it. Although it's really consistent. One thing that we saw, and Matt and Allie, if you want to weigh in here, that both the higher valuation as well as the higher amount of financing is sort of tracking to higher compensation, and it's also affecting the amount of equity that you have. So what are your thoughts on that? Maybe Matt or Allie, you want to jump in?
Yeah, I mean, I think you're saying, hey, e- equity has gone up maybe in proportion, equity grants have gone up in proportion to increases in compensation. We've observed that. We see less
Yeah,
of the
there's more money going into it, right? The higher the cash, and
Yep.
the equity is starting to stay really stable. We used to say that only the total amount of financing it was the way to look at it. But when we look at what the valuation is going up, we're also seeing that higher valuations are also keeping the cash compensation stable. So the higher valuation, typically the higher cash compensation, and also that the equity is starting to, the higher valuation, that the equity is staying stable, and it's also staying in a little bit of a more, yeah, Ali, you're getting this, so fill us
Yeah,
in.
I have a theory. I have a theory about, and just an observation about some of what I have seen in the market in the last couple of years. Certainly if we go back to the days of 2020, I'll call it 2021, where kind of anything and everything was going public by way of DSPAC, by, lots of IPOs, right? The machinery was working as it should, perhaps too aggressively, but there, from my perspective, there was a lot less focus on equity going out the door. And
Right,
now, with a longer horizon to exit, I think that boards and comp committees are a lot more aware and on top of the grants that are being made. And I think that that may, in part, have some of that may be coming through in, as you mentioned, stabilizing of equity
right.
and the size of the equity grants, because I have observed private companies moving away from refresh awards where they may have been granting them thinking that they were going to be public in the near term.
Right.
Those have become less common.
Right. And tech companies are not going public or having M&A transactions any faster than a life science company.
Yes.
Right. So Matt, on that, in terms of what you're seeing at Scalar, how is that affecting what you all are doing?
I would agree that that's what we're observing. As far as our piece in the puzzle and doing the valuation, it doesn't really have changes or non-changes in equity grants don't really have an impact on what we do, which is, how we value the company. Though certainly valuations, especially for longer dated companies,
Right.
yeah, there's been a dynamic added where companies actually have kind of shrunk. Some of the larger companies that raised high valuations in 2021, 2022 have decreased in value, which is, entails a whole bunch of different things from
Okay, we're
equity.
going to talk about that as it relates to
Right.
down rounds and other, what's happened with companies. So here I'm going to go back to my slides. And I'm going to make sure, looking at my phone, that no one is letting me know there's a problem here, but I think we're okay. So this is looking at that was the total amount of financing, and you can see that that's coming up to 200 million plus. And I believe in our surveys now, we've even put in over 400 million plus because companies are staying private longer. And then in addition to that, you can look most recent series of financing. Now we're up to Series F or later. So typically and also all the job titles. I mean, most companies start with giving everybody equity in the beginning, and then that seems impossible as you go down, as you raise more capital to give everybody refresh grants. So let's get into a little bit of the crux of this. All of these jobs we cover are chiefs, VPs, all the director level positions, over 300 jobs and all the staff level jobs. And the beauty about the J.Thelander data is it's only private companies. So it gives you that secret sauce of the mix between cash and equity, which is the very reason we're here, is that equity component is obviously the distinction between a public company and a private company. And it's given as a percentage of fully diluted shares. And then you get the valuation on it, which is what Scalar does. And the part of the J.Thelander that's great is that everyone who participates gets a subset of the results for no charge. And our data is real time. It's updated daily. And Ali will attest to that because we were futzing around with the slides as late as last night because we had more data points from 3 weeks ago. And so we had to adjust some of the information that we had used in our past webinar to make sure that it was up to date today. But all these jobs in the green are the ones that you get for no charge. So a lot of data. It's enough for many companies just to get the information that they need. So let's move into equity grants and the type of equity grants that you get. And Ali, I'm going to turn this over to you.
Sure. You can see as evidence here, most common incentive stock options and non-qualified stock options, those really make up the bulk. Restricted stock units, restricted stock awards. What I would say about restricted stock awards and restricted stock units is that they are both full value awards, and really I consider them somewhat special purpose, but certainly restricted stock seen most commonly in founder grants. Those are given at the very earliest stages. Often people are receiving those grants and not paying for the stock or contributing perhaps IP, et cetera, to the company in exchange for the stock. Restricted stock units, of course, granted by late stage private companies. I once in a while see a company that is a private company grant an RSU before they're ready. Right. I would say they're complicated, a lot of hair on them. They're great incentives for the right company, but if you are an earlier stage private company, I would suggest steering clear.
Yeah, one of the questions that came up, which I know you're not a tax attorney, but the different tax treatments for this. It said,
Yes.
The question was, what are expectations of prospective senior management employees for equity-based comp, RSU versus an ISO, and related imputed income tax issues?
So I, Jody, am in fact a tax lawyer and have a master's degree in tax. So you got the right person for this one too. But
we got a double whammy, our comp and actually you're comfortable to talk about the tax.
So incentive, and I'll keep it very high level because obviously disclaimers about who we represent, don't represent, all of that, and dependent upon particular circumstances, tax position, et cetera. But as a general proposition, an incentive stock option is an award that can be granted that has beneficial tax treatment if the shares that are acquired upon exercise are held for at least a year post-exercise, and the shares, I say a year, so it is the longer of 2 years from the date of grant, a year beyond exercise, and then you can actually get beneficial tax treatment. Part of the reason that I had mentioned the RSUs having a lot of hair on them is that RSUs are, at their core, really were originally developed as deferred compensation. And so the tax can be really complex, and RSUs are a particular type of award where you can end up with what we often refer to as effectively a dry tax, meaning that there's taxation in the absence of liquidity, right, which can be very problematic for private companies.
Yeah. Matt, in terms of, so let's say you raise capital, right? This is what happens. The company raises money and they grant the equity, and then they come to you. Because whenever they raise capital, that's really the call to action for the valuation.
Yeah. there can be times where companies are granting equity outside of raising capital, but that is the primary trigger. And it's nice for us because we can rely on that fundraise as an indication of value. One might ask, well, why do you even need a valuation if you just raised money?
Right.
And the answer is, well, you probably just raised money with preferred stock that have unique economic terms. So you sold Series A for $1 per share. But for all of those, equity issuance that you just showed, you really need to know what the common stock is worth. And, there's some economic differences. So if the preferred stock is worth $1, we kind of know it's worth $1. You don't need an evaluation for that. The market just told you that. But there is some exercise in saying, well, with that knowledge, does that mean the common stock's worth 50 cents, 70 cents, 30 cents, 25 cents? And so a lot of our valuations are kind of using that fundraise to go from a preferred stock value, which is known, to a common stock value, which is unknown.
Ali, do you want to add to that to simplify for someone who's listening? Like, okay, what exactly does that mean?
So I was just thinking about simplifying that. At its base, and what I would say is this from a valuation perspective, really, the 409A valuation is a construct under the tax law and effectively nothing more than that, right? It's a valuation for that purpose and that purpose alone. And as long as you grant stock options with an exercise price at least equal to your 409A valuation, you then are within a safe harbor and don't have deferred comp that is problematic under the code. But it is a number that's different from, and I think, typically it's a number different than what is the actual value of the company. So it isn't necessarily fair market value. It is used for tax purposes. But I think, Matt, you probably agree, right? It's like it is important too to make sure that when you're having conversations about the value of the company, that it's for what purpose.
Yeah. Yeah. Or said another way, in valuation, there isn't really a right answer. There's a range
Yes,
of right answers,
fair.
and there's definitely a range of wrong answers as well outside that. So it's our job to kind of make sure that we fall within a defensible range. But oftentimes with these equity issuance valuations, and not always, there's a whole bunch of factors, but oftentimes the lower number that can be defended, the better, at least for the recipient. And so
Well,
it's,
because the
hey,
wealth creation comes on the spread between what somebody was granted equity. Let's say they get granted, and this is what we're going to talk about because the role that J.Thelander plays in here, and we had a question on this, is we help you understand with all of our survey data and running data from our platform or consulting, we help you figure out exactly the mix between how much cash and how much equity. So if you are the CEO, then what should your total amount look at the total amount of financing and figure out what percentage of ownership you should have. And we start with the bigger picture of like, what does the option pool look like and who gets what, right? And then from there, once you know maybe you're the founder CEO, you have 12% of the company. Then you get a valuation to understand what is the strike price and what do you own, how do you own it, right? How has it been granted to you? Because that's important. And then you work with Ali and Cooley to either get your employment agreement or the company works as counsel. And then you've got to get the valuation to know what the strike price is. So let's say you pay, it's 5 cents a share and you actually then could buy the equity, right? Because if you hold it, then that's the trigger for the capital gains.
yep, exactly.
Okay. I'm going to go, I don't know, I'm a little trying to decide here. I think we should go into option pool because I feel like the option pool piece is, I want to make sure that we keep this straight about the compensation because backing into refresh grants and all the questions that come on here about whether you should have anti-dilution clauses and so on. Maybe what I'll start with is the actual compensation numbers because I think that will make the most sense. Let's look at some scenarios here on the private company executive compensation because this is sort of where it all starts, right? So with the compensation, you have different levers. Base salary, we track current bonus on the J.Thelander surveys, which means it was a bonus that actually was given. The target bonus is what's out on the horizon for the next year, short-term incentive because it's a year, and that gets you to total cash. And total cash can be a combination of base pay and a bonus paid out, or especially for many young companies, it's just the base pay. And then we have three different buckets of equity: founder shares, and then founder shares for the current job, meaning you're the founder CEO, and then you got more equity past your founder shares, or you come in as a non-founder and you get non-founder equity. And Allie, there's no one true definition of a founder, right? Like it's really a sort of a point in time.
That's right.
Okay. So here's some equity. And I'm going to show so the mix of cash and equity. And then this is by financing. So we show you the total cash and then non-founder shares and then total founder equity. And again, the total cash could be combination of base and bonus or just base pay. And you can see here that we start with the financing of less than 15 million, and we did the bucket of 90 million plus. And really, if you reflect on this, and this is once you grant this equity at some point, that's where you use Scalar, right? Matt, you're the other piece in this because you want to know what is the value of this equity. So
Yeah.
I feel like this is a really good starting point for the folks here on our webinar. And again, feel free to ask questions, but you can see the total cash, just like we discussed, is going up based on the total amount of financing. And then here's another, and then the equity for the non-founders, short of starting at a very early stage at that 6.75, you can see that the median is around 5%. And so this sort of falls into some of the, and then I'm going to show you, here's by valuation. I'm going to show you the different scenarios. So here is by valuation and the total cash again going up, similar, not that dissimilar, right? 235, 330, 450, 532. And now we're by valuation. Numbers are really comparable. I actually did a double take on this. Morgan on my team will attest to the fact that I was like code red last night saying, is this right? Because the numbers are so close, and it is so close and it is right. And this is the valuation numbers, right? So things are staying pretty comparable. That 5% again, you're seeing. And then we also did it by funding stage. Not quite as consistent. And maybe Allie, you want to speak to this, like, because funding stage is sort of choppy right now. Maybe Matt, you have something to lend on it too.
Yeah, Ali, I can defer to you or happy to hop in. But yeah, I think funding stage, when everything's up and to the right, there's a lot more consistency. Series D company looks more standard. Right now, you've kind of went through a rise and fall of kind of a COVID bubble, and so funding stage can be there's a little bit more disparity and wider range of winners and losers, which probably tweaks the data a little bit.
Yeah, and Allie, I mean, we're seeing some funding stages that they're just not as consistent, right? Somebody's Series A could be somebody's Series B because the amount of financing someone's raising in a round is inconsistent.
That's right.
Okay, so we're going to go back to this so we can keep looking at the data. So you can see that the Series C or later, just what Matt said, I think you're right. Once you're getting to the later stages, it may equalize out, but you can look by Series C or later, the total cash at 450 versus if you look at the valuation versus the total amount of financing, much more accurate, which of course is the optimal situation. And then here's the same information. And then we look by head count. All the different ways, because this came up in our questions, like which one is the best one? I would argue that the best one is total amount of financing. Matt, Allie, you have an opinion on that?
It is definitely, I think, more objective a measure than a which round are you in, given, right, you could have had a smaller round to begin with. And then, so the total dollars in would be a more objective, right, consistent measure.
Yeah.
Company to company.
Yeah, I would agree. It's kind of subjective what companies name their rounds, and sometimes they're incentivized to stay at Series B for a while. So it's Series B, Series B1, Series B2, Series B3.
Right, but I think the next best way from what the data is showing us is that valuation is really the next best way to look at data. So when you're looking at the median total cash or even the 75th percentile total cash, that is increasing with valuation as well as with the total amount of financing. And that I mean, people ask questions here on the dilution and what happens with what if you have an anti-dilution clause, what happens if you have a down round? This is like obviously a very monumental question that keeps coming in. So What we talk about here, I'm going to show you this slide, and then we can move into, Allie, you talking about the down round information.
Mhm.
You look at series versus total financing, versus the head count. You can see that with the total cash, that the series and the financing in the early stage happens to make sense, right? And then the founder total equity and non-founder equity, very consistent. But really the total financing is getting you to what would probably be and head count really is not a great way. And that the main thing is that you use the data, right? And here's the 75th percentile by financing, that you use the data to give you a guide to show you what's going on in the market. And you can see there's a big difference, right? The by financing the 75th percentile, the total cash is definitely up. And in addition to that, the equity is a little higher, although at these later stages, the equity becomes even more consistent around that 5.25 or 5% for the non-founder. But the reality is that all roads lead to getting it right in the beginning. Because if you have some anti-dilution clause and you didn't have enough and you get diluted down, then you probably will get more equity. If you have an anti-dilution clause and you got too much and you're still high, chances are that you're going to have to do something else. So Ali, talk to us a little bit about what's happening in the M&A world right now and what's happening with these anti-dilution clauses and how effective they are, if at all.
Yeah, well, I have 35 minutes left in our time together. I'll be spending all of it. Now, I do think that, one of the things that just came to mind to me, Jody, was when you had mentioned sort of getting it right. Because one of the situations that I have seen is where, what you don't want to be doing is a effectively like a whiplash, right? If there is a change in your valuation, I've seen companies rush out to reprice stock options only to have the value further decline. You've got to think about people coming into the organization who are new and kind of, making sure that you are not being reactive. The other thing to consider too, and you had mentioned anti-dilution, one of the things you want to make sure that you're on top of out of the gates is whether folks that are receiving their equity awards, what types of restrictions do you have once they've exercised their options and are holding stock? Are you basically subjecting everything to a right of first refusal with the company? Because one of the things that can happen is you can end up with folks within the company who have been there for a while. Their equity has vested, they've exercised their options, and they're getting liquidity and selling into a secondary market, whereas other people can't, or haven't yet had the opportunity to do so. And now they're back at the table and they want additional awards.
Yeah. I mean, we see the ask for additional, a lot of our consulting is people are fully vested or we didn't give the right amounts, but we can't now, when we look at our option pool, we can go to those slides. We don't have enough equity for everybody. So there's no way you're going to be able to give more equity regardless of who is given the right amount or who is given the wrong amount. So getting the right amounts right first are very important. And the data is really stable. You can see this even looking at the averages, the medians and the 75th percentiles for all of this, right? And I'm going to show you right now another slide just to give you a sense of this, just sort of a random slide on data because we pulled so much. And all this data, as I said, came real time from our platform. So I'm going to keep plugging that people participate because it's how we get this data. And everybody at a certain point is like, okay, we just had our valuation done. We worked with Scalar and we now need to know whether we have the right amounts, the equity amounts. We've raised more capital and we need to assess this. So it's really important to participate. The link is going into the survey and all this comes from our platform real time. But you can see now, we showed a cut of data for median total cash and equity for a med tech company, for example. 2022, 23, 24, 25. And we know that 2023, and Matt, you must have seen this in Scalar where the valuations were starting to be really high, that these amounts for the non-founder equity stayed pretty stable. The founders went a little bit more up and down, and the total cash, though, you can see staying pretty stable. But if these valuations went up really high and now the valuations are going down, how is that impacting giving the additional equity grants? And that's where if your stock is now underwater, you still can't give to everybody because even, and sometimes it even has to come from a founder CEO, right, Ali? I know we discussed this.
Right. And I've seen circumstances where there was reluctance by the investors to suffer further dilution with additional awards, and founders have stepped in and said that they would give up a portion of their holdings so that there was dry powder available in order to give additional grants to their team.
Right. So here's what we're talking about here, because I always find this so interesting. So this is the option pool information, right? So here's all reported data. But then we break it down by the different stages. Seed stage, which we look at under $5 million, and that's where the founders can hold a lot of equity, and the different percentages of equity are predicated on how many founders there are, and the investors hold less, but the employee pool is around 10 to 15%. And then when you raise more capital, the founders are getting diluted, the employee pool is staying around that 10 to 15%, and the their holdings are going up. And then a late stage company in that 90 to 150 million of financing. I mean, it could even be more, but you can see the founders have been really diluted. The employee pool is staying pretty strong at that now 12 to 15%, and the investor piece is coming up, right? So if in fact there has to be more equity going to people, then it's got to come from somewhere, and the investors are really reluctant to have that happen. So if it's come from more from if the founders had too much, then it's got to come from somewhere. And Ali, what you're suggesting is that it comes from them.
Yes.
Yeah.
That is a potential source for sure.
Yeah.
Right. And right with the investors, obviously, the longer path to exit means additional dilution, means their returns aren't good. So there's a lot of focus on obviously wanting to make sure that they're protecting their returns to the extent that that's possible, right? For so long as the exit horizon remains uncertain.
Yeah, Matt, I have a question came in regarding valuations. So walk us through the valuation process. And then they wanted to know during the valuation process, then at what point, why would somebody getting a valuation want to consider speaking to J.Thelander? So I'll let you talk through the valuation and how this goes, and then where the conversation would potentially turn over to us.
Yeah, yeah. I'll answer the second question first, which is we're just a piece of the puzzle, where if you're granting equity, you need to know what that equity is worth to set the strike price, or for tax ramifications if they're restricted, stock. But how much equity to grant, how many options to grant, or how many shares, and what's market, that's all, the valuable data that you guys have at J.Thelander. So they kind of go hand in hand. You could almost talk to J.Thelander before us, or us before them. As far as
Right, you get the valuation and you go through your process and you realize, oh my gosh, I don't own enough.
Yeah.
It's exactly right. Well, Ali, you're smiling. What are you thinking?
It's a little bit of, I'd say chicken and egg, right? All of these pieces need to come together. And there isn't one determinative. What I was actually just thinking through was, with the valuation, like a piece of this that is really difficult is often when you're granting equity and in the form of a stock option, right? A stock option doesn't have value unless and until the value of the company increases. A lot of times the person receiving that award wants to know what its value is on the date that they receive it, which necessarily means that the company is saying, okay, company is worth X dollars today. This is what it is at X plus 5, X plus 10. And, I'm a lawyer, so we're always cautioning clients to be very careful about how it is and what it is they're communicating around value, because it's complicated. And you don't want people, you don't want to be in a position where you're misaligned.
Let's talk about that. What if somebody takes that valuation and the company says, oh, well, here's your total comp. Here's your cash compensation. Here's the value of your stock. I mean, when we're consulting, we say we want to stay away from the value. The value is meant so that for if there's a liquidity event, what the wealth creation is going to be, or if you're paying taxes. But you cannot count that, is exactly why with the valuations going up and down. So right. You can't count that, as you got to be careful about talking about the value of the stock as being part of the compensation.
Right, which I presume is the reason that you guys have broken it out separately with the buckets of, right, you've got dollars and then you've got percentages for the equity piece.
Well, that's where we're working with Scalar because we don't give the dollars. Only Scalar
Oh, I
gives
meant not the dollars on the comp front, like
the dollars on the comp front.
yeah.
Yeah. Like here, let me give you an example here. I'm going to show this. Let's see.
And I have seen a lot of very heated conversations, right, at the comp committee and board levels around, okay, how are you figuring out how much equity a person is going to get? And is it, in some instances, they'll take a dollar value, they'll divide it by, the 409A value. In some instances, it's person who came in before them in a similar role had X shares. That's how many potentially we have available. That's what's come back into the pool. So there are many, many ways to figure that out.
If someone gives you a dollar
Yep.
amount, that's
Okay.
that's not, this is what we look at. So here's an example, because I know we've
Yep.
got a variety of people on the call as well. So here's a CFO, for example, median total cash. And we're presuming that the CFO is a non-founder. Now, this is a perfect job because a CFO is sort of industry agnostic, but you can see that the less than the 50 million for life sciences, more total cash, and then more equity. And then they've gotten a little bit diluted down from the 1.35, but here is showing you that the 1% is staying pretty consistent all the way through the 50 to about 130 million and 130 million plus. And the total cash is going up a little bit. But this really shows you, this is sort of, let's say they come to Scalar, right? Matt, you've given the company a valuation. And so you are assuming that the CFO who had the 1%, that they got diluted when they raised more capital. So then they did get more equity.
Yeah, yeah, absolutely. The company to maintain 1%, you'd almost certainly have to be granted more equity because the company has issued more shares in the financing.
Right. And this goes in here too, if we look at this slide, and this is what Ali, you were talking about as well. Let me pull this up. Okay. So this talks about, do you have an evergreen program? And most people do have some kind of program, but it's not a formal program, or they say no. And so if you have a program, when do you do it? And as needed after financing. And this is exactly, I mean, everyone talks about like, what's the right answer? The right answer is that you try and get it right to begin with. And then because you've got to figure out as you go, it's really on a case by case basis.
That's right. And so many variables go into that determination, right? And it could very well be the case that when you made the grant, you did get it right. But
Right.
facts, right? I saw a question about sort of macroeconomic and
Right.
the rest of it. Like a lot of companies are sitting in a spot that they didn't think they would be in, because it was presumed that when that equity was granted, that the exit, the IPO, the M&A transaction was within 2 to 4 years, and here we are 5, 6, 7 years later.
Right. So that was talking about if there is a reverse split. Maybe explain that to us a little bit.
It was reverse. I saw the question about the split, but yeah. So one of the things that can happen is in connection with particularly an IPO, there's usually a desire for, and this is often we see this with what I'm going to describe as life sciences companies, which I know, Jody, you guys more appropriately slice and dice it into like more granularly into
everything, biotech,
yes,
medical
biotech,
device,
medtech,
diagnostics.
device. Yes. I refer to that more generically as life sciences. It's all on the science side of the house.
Right.
As our practice is broken up into our, as a firm, it's mostly tech. You're either tech or you're life sciences.
Right.
But for life sciences companies, you're typically targeting around a $10 to $20 share price on an IPO. And what that can mean is that you go from, you can often have a split, reverse share split, which means if you had an option to acquire 2 shares, you now have an option to acquire 1 share. And the overall value should be the same. That is the intent of the split. It just means that the stock price is higher, and you'll own fewer shares.
Right. Matt, do you have a thought on that in terms of the valuation and how far Scalar gets involved in these things?
Nope, just agreeing that you're changing the denominator, but if a company's worth 100 million, it has 100 million shares, dollar per share. If it has 200 million shares, 50 cents per share, but the dollar amounts stay the same. Somebody had asked about the valuation process. They asked two questions. I didn't get to that one. I'm not sure if it'd be helpful to briefly
Yeah,
walk
I think
through
it would
our.
be because it's a lot of stuff is a lot of the questions coming up really, which shows how sophisticated the folks are on this call about repricing of options, right? Where the current valuation is substantively lower than where something has historically been. So walk us through that, Matt. Somebody comes to you to Scalar for evaluation of the process, and then what happens again when the valuation goes down?
Yeah, yeah. So at the highest level, our valuation for equity issuances is really a two-part process. Hey, what's the company worth? And then allocating that across the cap table to say, what is a common share worth? To value a company, there's lots of ways to do it, but you're looking at cost, market, and income approaches. At its purest form, valuation, a company is worth the present value of its future cash flows. Oftentimes, those are highly uncertain or highly just very difficult to predict. And so for later stage companies, we will do a DCF. For earlier stage companies, and even really any company, there are other call it shorthand approaches. So applying multiples to revenue or multiples to EBITDA, which you'll often hear. You can look at other fundraising comps and say, hey, what are other phase two, pharmaceutical companies raising money at? What's the approximate valuation? We'll look at the public markets. Oftentimes, even to value private companies, it's imperfect. You have different size companies, but the advantage of the public markets is the data is rich and it's
Right.
real time. On Scalar, and we're happy to provide this website
Is
or
there a shelf life of evaluation?
for compensation. Evaluation is typically considered good for up to 12 months or until a material event has happened. So if you got a valuation done last month, fast forward 5 months and you raised another round at a different valuation, that's obviously a material event. But usually we're doing valuations potentially annually for companies. And yeah, to your question about repricing, oftentimes we'll have companies that raised money, it's been 36 months. We can't rely on that fundraise anymore. So we're looking at their actual financial performance, and maybe it has fallen short of what expectations were then. And so you raised money at 300 million, but we're now saying you're worth 150 million.
Which
Um,
has happened. I mean, we've seen
right.
all of this,
Yeah.
right?
Yes.
Right.
And just a note on the 409A valuation and shelf life of a 409A valuation is that one thing that's really critical to understand is that, as I mentioned earlier in the hour, a 409A valuation is a safe harbor um, to the deferred comp rules under the tax code. It is very technical. And what
Right.
that means is that it is easy to foot fault. The safe harbor on the 409A valuation is for 12 months. That is the outside date. And a couple of days will make a difference. You cannot rely on it for a day longer than 12 months. And
Right.
as Matt has just mentioned, those valuations are good absent a material change in the company, which would include a financing. And then we get down into, I field a lot of calls about, hey, we have a term sheet, we have a this, like, what are our circumstances? Can we grant now? So really timing does matter. And you don't want to find yourselves in a spot of having relied on a 409A valuation erroneously and finding yourself outside the safe harbor.
Right. Because then the problem is that you can have issues with this.
Yes, you could have issues with it. At its core, the a violation of 409A of the code results in an additional 20% excise tax. I would say, as a practical matter, part of the reason you want to make sure that you're really careful in terms of your process is that as a private company that is looking to raise money in financing, the last thing you want is a more junior version of, an associate doing what I do, who's like a dog with a bone, digging into your process and practice with respect to option granting
Right.
and discovering that something is sideways with your 409A valuation and then forcing the company to take action that it doesn't want to be taking. Remediating a misstep on the 409A front is not easy to do. And I'm sure, Matt, you've seen those situations where companies maybe went out without a 409A valuation and then investor came in and said, now you've got to go get a retroactive valuation to support what you've already done.
Yep. Yep. Absolutely. It's as you know, one of the due diligence checklist items. So we certainly have had clients where they're about to get acquired for large money and they're taking in time. Thank goodness they had the ducks in a row in the 409 evaluation. But can be messy.
We had a question about, well, we had two questions. One is there a difference in geography with comp data?
Mm.
And and I can attest to the fact that there is not a difference in geography. And there are pockets, and we just were working on our Caplander podcast. We had John Norris on, who does the debt financing and came from Silicon Valley Bank, and it was very interesting. And he said, of course, for things like life sciences, there are areas that are really popular and where there's competition for talent. And it used to be really the Bay Area was the highest. Now Boston has become the hub for life sciences. There's also stuff going on in San Diego, and there are, other areas in the country. So it really depends on the job and on the industry and on the company. And then there are really tech pockets all over the place now. I mean, nothing has come back to what it was before COVID or even in those go-go.com days in Silicon Valley. It is really spread out. And we have global data as well on our platform because we're doing a lot in life sciences in the UK. And even that data for the top levels is very competitive. It changes at the staff level. So it depends. That's why cutting data by location can work for you with one job, but it may not be consistent for another job. The best way is to look by the industry and or definitely look by the total amount of financing in lieu of the industry because some jobs have become very competitive across industries. And then we just had another question. I think this goes to both Allie and to Matt. Is that does the conversion price of the preferred stock play a part in the valuation of the common stock? So how, what happens there?
Yes, I would say the conversion price most typically starts at 1 time. So you raise, sell a common share, issue a common share for $1. It likely will convert into, sorry, a preferred share for $1. It will most likely convert into a common share for $1. So that's kind of the comparison. But if
Right.
there's a higher conversion price from the get-go, which we've seen, or if things have happened, anti-dilution, things that adjust the conversion price, that either further differentiates the price of common versus preferred or makes them more similar in some rare instances. But yeah, we reflect all of that in our valuations.
Yeah. Allie, thoughts on that?
No, all of that makes sense. I mean, I guess it goes back to the really your preferred value shouldn't be playing a part in your equity awards. I often see companies, and I say it shouldn't. If you're
The
granting
value
stock
should not be
options,
playing a part. That is really the crux of what we've been saying here and so important is that the value should not be playing a role in the percentages that you give.
yep.
It that is a separate conversation. The last thing that I'm going to share here, and I'm going to move this to full screen, also are the staff level pay bands, because we have quite a few upgrades that are coming onto J.Thelander showing year over year, and also where you can come on as a company and design your own pay bands and be able to really get into more granularity here on the platform. And it's really important with using real-time data because at some point you're going to have to not only be looking at the executives because they're not the only key employees, but there'll be changes that will allow you to be looking at these pay plans. So you can look at director pay plans and manager pay plans, and you can see that these count for administrative folks, scientific folks, and technical. And all those 300 jobs, a lot of those people are getting a mix of cash and equity. And so understanding the valuation and being able to articulate that in using these percentages and having order to your compensation structure, which also is order to your team, so that as things are changing, it's very important because sooner or later, if there are inequities, that whole landscape is going to shift downward. It's like, it reminds me of that building in San Francisco, the Millennium Towers, right? That was built
Hmm.
on landfill versus bedrock and it started to tilt, right? And so the sooner you get your compensation in place and make sure the mix between cash and equity is right, the percentages, and that you have pay bands and structures to be able to keep your house in order, and then you understand the valuation piece of it, the better off you are because everyone keeps asking, like, is there a standard top up time when you give people more equity? Are there standard refresh? Are there standard protocols? And there's nothing standard. It's all predicated on how good of a job you did to start with. Because, like you said, Allie, the company profile can change. It can take a lot longer. You may need to raise more money. There are a lot of different confluent factors that come into play here.
And Jody, your description of the Millennium Tower in San Francisco is a great one. I often like the analogy that I use is two boats leaving from the harbor at the same time, and one of them heading kind of straight out, and one slightly off, from the target. And when you
Right,
get out to the horizon, they are really far apart.
right.
So better and easier to get it right in the first instance than to try and correct down the road.
Very challenging. When you make mistakes, it's very challenging. We have one last question come in, and then we're going to do our wind up on. So, Matt, you can think about what you're going to impart wisdom to everybody. But the question said, how do you target stock comp for employees that have been hired much later than their colleagues? And my recommendation on that, if you look at this, for example, and everything that we show you has a 25th median and 75th percentile for both total cash and equity. And for in general, there's going to be the earlier somebody comes in, the more equity they're going to have because the valuation is lower and equity is easier to give in the beginning because there's more of it and it's not as much of a commodity. Later on, just Ali really shows the strength of tying all this together. That option pool is still saying 10 to 15%, but if to keep that fluffed up, the option pool at those levels, it has to come from somewhere. And the investors are not keen to be contributing all the time, right? That they don't want that to come from their pool. So it's really important that you look at the equity percentages in the beginning and that you appreciate that they're going to adjust and that maybe you're going to use the lower percentiles, the 25th percentile, to grant equity to later employees because it's less risky and you have a little more cash to be able to give them. But again, this is all about what's the balance and how well did your boat leave or what floor of the Millennium Towers are you on? How far are you tilting and you put the marble on the floor? Is it running straight down or is it really going off to the side? So Matt, I'm going to turn over to you to give us to be respectful of everyone's time. What's your best guidance for the folks that are here? What's the takeaway?
Two thoughts, one valuation focus and one administrative focus. On the valuation side, obviously with your data, your clients can ensure that they are granting the appropriate percentage of, equity, a fully diluted ownership percentage to, the appropriate employees. But you want a valuation of that, one, to make sure it's defensible with the IRS and tax authorities. But two, you want a good valuation provider because there is a range of reasonableness with valuation. And just because you have 1%, that is typically granted in the form of stock options. And so your strike price, you might be buying that 1% for 150,000 or 75,000, and both could potentially be defensible based on how you structure that valuation. So it is important to, be thinking about it competently. And then secondarily, and this is a little bit of a statement and a question for Ali. She'd mentioned footfalls. We do a lot of valuations, and that's what we focus on. But we see pain sometimes that our clients experience if they did something in an incorrect order. We'll often be asked, "Hey, can you do a valuation as of March 2023?" And the answer is, yeah, we could do a valuation as of March 2003. If you had a company back then, we could tell you what it was worth.
Right.
Whether or not you can use that valuation is a different question. And our understanding, and Ali, I'll let you confirm or clarify this because I'm not an attorney. Uh, Oftentimes we'll see companies that recruited an employee promised options but never went through the formality of board approving them. And it's typically the board approval date. And so it's like, yeah, we could tell you what it's worth back in March 2023. This employee should have received options with this lower strike price, but you never got around to granting them. So you probably can only grant them at today's price, which is potentially higher if the company's appreciated.
That's
That's
right.
all.
That's right. And I guess a perfect segue because I can appreciate that for a private company, particularly at the newer stages, hearing from Matt, from Jody, myself, it can seem quite daunting and expensive to involve all of these experts in what's happening at the company. But it really is critical to make sure that get your boat in the water and heading in the right direction from the start. And
Right.
an investment at the front end in getting all of your systems in place can really save you a lot of time, dollars, and heartache down the road. And I am very adept. There are a lot of companies out there who don't take this path, and I'm very adept at fixing a lot of things. It is very expensive to do that later on, and can, throw up roadblocks to financings, to transactions, can be expensive and costly for founders who are asked to give special indemnities in connection with the sale of the company. And those things can be used as leverage in connection with a transaction. So as I said, it can be daunting and seem expensive, but really the value of the data that Jody has collected pays for itself multiple times over down the road. Making sure you have a valuation expert like Matt involved at the front, really critical as well. You can talk to me a little later, but really important to get your equity grant processes in place and have a solid approach to doing that to avoid having to correct things down the road.
Yeah, that's a perfect ending. The other thing that I would like to emphasize, which is why we work with Scalar, is the quality of what they do. And there are other versions of getting valuations, but the unique nature of what Scalar does, which is why we work with you, is that the quality is very high. And that's the same thing that we pride ourselves on at J.Thelander. I know Morgan put the survey link into the chat here, because if you do participate, you get data back from, which is a lot of what we covered today. And having that information is extremely helpful. And we pride ourselves on the quality in the real time. And Cooley really doesn't need much more to say on that. But Ali, it's always a pleasure, because it really seems like you wear many hats, but you really know your stuff, and we appreciate your expertise in working with us today. And thanks to all of you. We'll send out a recording. If you have any questions, please let us know. And we look forward to working with you in the future. Thank you.
Thank you.